What's up, guys? It's Cody Steck back here with another episode. Today we're talking about seller financing. We're going to be talking about what it is, how it works, and how you can use it to go out and find additional deals in your marketplace, even if you're not able to get qualified for a bank mortgage. Before we jump into this, if you would, just go ahead and click the subscribe button on the channel here. Click the bell to get notified when I drop new videos like this. If you're interested in anything real estate, business, or passive income, you're going to want to be subscribed to the channel here. There's tons of information and I'd love to connect with you. Now, before we really jump into this, I should say that you want to make sure that you fully understand the terms of how seller financing works, because it can be very easy to get in a tight spot or even to screw over the seller if you don't know what you're talking about and you set it up wrong. You don't want to ruin your reputation in this business. You want to make sure that you're providing good information and that you can follow through on what you're promising to these sellers. So you want to make sure that you consult with your attorney and with your CPA so that you have a good understanding of how this process works and kind of what you can expect as you go through the process of buying a home with seller financing. So there's really two types of seller financing that we're going to be talking about here. You've got your contract for deed, and then you also have your all-inclusive trust deed. The first thing that I want to talk about here is contract for deed. This is probably the more common type of seller financing, although I'll be honest, I'm not really a fan of it because as the buyer, it's not as beneficial for you. A contract for deed is basically an installment sale. It's where you agree to make payments each and every month, and then once that final payment is made, then they give you the title to the house. This is kind of like how a car loan would work, right? You go and you buy a car, you get a loan on the car, and you send the title to the bank. The bank holds the title to the car because they're the holder of the collateral. You make your payments every single month, and at that point, they then give you the title to the car. So that's kind of how a contract for deed works. You can also get the title to the home if you refinance it. Let's say that you do a contract for deed for 12 months, and then you decide to go and get a regular mortgage. The seller's going to transfer the title to whoever the holder of the mortgage is. This is a better way, depending on your state. This could put it into actually your name where you've got a mortgage, or you may have like a trust deed and a note. We're not going to go into the specifics on the differences of those, but I think most of us here kind of know what a mortgage is and how that works. The other cool thing that you can do here is, let's say you buy the home on a contract for deed. Maybe you do some fix up to it because you have the legal right to do so, and then you flip it and sell it on the open market. Now at this point, you've never actually held the title in your name, but you can sell it and then collect the difference of whatever you bought it for versus what you sell it for. Like I mentioned, this is not my favorite method of seller financing because as a buyer, it's a little bit more risky. If you stop making payments, it's actually very easy for the seller to take back the property. Now, of course, as real estate investors, we never really plan to stop making payments, but it does happen. You know, maybe something comes up, you run into rough times, and you need that extra time. A contract for deed really puts the power of the property into the seller's hands. So I want to jump into the next option, which is all-inclusive trust deed, and why it's a better option for you as the buyer if the seller will agree to it. So the difference here with a all-inclusive trust deed is that the title actually transfers to your name right away. What happens here is the seller basically becomes the new mortgager on the property. Now, if the property is already paid off, then the seller is basically becoming the bank. Instead of going to the bank and getting money, the seller is basically indirectly lending you the money through the property. If the property is not paid off and it already has a mortgage on it, what you're going to do is you're going to do what's called a wrap mortgage. You're basically going to leave the existing mortgage in place, and you're going to get a mortgage that kind of surrounds that existing mortgage. So let's give you an example here. Let's say that the seller bought the home maybe 10 years ago. They paid $200,000 for it, and they now owe $150,000 on the property. Time has gone on, the property's appreciated in value, and now it's worth $250,000. Let's say that you're going to pay $250,000. The seller owes $150,000 on the property. So let's assume that you're going to buy it and not use a down payment. Just to make the numbers easy here, you're going to get a mortgage for $250,000 that you're making payments on to the seller. Now, of course, the interest rate and the terms, and if there's a balloon payment or not, this is all negotiable between you and the seller on that wrap mortgage. So you might go to the seller and say, hey, I'll pay you $250,000. I want a 30-year term, and I want the interest rate to be 4.5%. Let's say that they agree to that, that's great. They're gonna continue making payments to the bank, you're gonna make payments to the seller. This is actually how the wrap mortgage works and how it works on the financial side. Now, jumping back to the all-inclusive trust deed, that's actually gonna show how the property title transfers to your name. So you've got the mortgage on the one side that covers the financial side, and then you've got the all-inclusive trust deed, which actually covers who's on the title. There are a lot of nuances, and of course some of these things are going to change from market to market, so just make sure that you're fully aware of how this works and you have a pretty good understanding. If you feel a little bit uncomfortable, I don't want you to not take action because of this. Just make sure that you consult with an attorney or even a more experienced real estate investor that can help you structure a deal like this so that you don't run into future problems. Now, one thing that I do want to mention when doing seller finance is that if the seller has a mortgage in their name and on the property still, there's a couple things that you want to be careful with, because in most mortgage documents, there's what's called a due on sale clause. This says that if they transfer the title to a new person, the mortgage company can actually call that mortgage due, which means that the full balance of the mortgage would be due right now. Now, you might be thinking to yourself, crap, that's gonna put me in a really tight spot. You don't want this, so there's a couple things that you need to be aware of if there's a mortgage on the property. So the number one indicator of what notifies the mortgage company that the title has transferred from the seller's name to your name is typically the insurance. If the insurance gets canceled, the mortgage company is gonna be notified of that and they're gonna start looking into it. The best way around this is really to just double insure the property. Make sure that the seller leaves the insurance policy on the property, and then you can double insure it by putting your own insurance policy on the property. Now, some of you might be thinking, well, hey, this sounds sketchy, this sounds illegal, I'm not sure I want to do this. It's okay, it's not illegal. Typically in most of these mortgage documents, it's just a clause saying that, hey, if you sell the property, you need to pay the mortgage. If the mortgage company is still getting their payments, they're gonna be fine, they're gonna be happy. They wanna have that money loaned out to you, and they wanna continue to collect on that interest every single month. Which leads me into the second thing that I wanna talk about, and that is to make sure that you use an escrow company to continue making those payments. Like I mentioned, if you're making payments to the seller and then they have to make payments on their mortgage, that can get a little bit of a sketchy situation. You want to make sure that when you're making those payments, the seller isn't just collecting that money and then taking it and running off with it. You want to make sure that the original underlying mortgage is still getting paid. So the easiest way to do this is to use an escrow company as a middleman between you and the seller and the mortgage company. Basically, what's going to happen is you're going to make payments to the escrow company. They're going to pay the original mortgage that's on the property, and anything that's left over will go towards the seller. This is really the way that you want to do it to make sure that that original mortgage continues to get paid every single month. Now, the cool thing about seller finance is that there's a lot of benefits for you as the buyer as well as for the seller. Some of those benefits include not having to qualify for a bank mortgage, so it becomes much easier. The sellers might be more lenient on what kind of credit or down payment they require on the loan. And for the seller, they can take advantage of things like tax benefits because they're not receiving a whole lump sum all at once, and they get the consistency of cash flow each and every month. So guys, I hope this was helpful for you. As always, drop a comment below, subscribe to the channel if you haven't already done so, click the bell to get notified when I drop new videos like this, and give me a thumbs up here on the video. I'd really appreciate it to help with growing this channel to provide you guys more awesome content like this. My name's Cody Steck. I really enjoy being here with you guys. If you have any questions about seller financing, I know we kind of just briefly touched on the surface of this. Drop a comment in the comment section below. I'd be happy to answer any further questions that you have, or even if you want me to shoot a video on further topics or go deeper into something like this, let me know. I'd be happy to do so. And until next time.